Once again, I welcome you to this video today. I am your host, none other than Mr. Spotter Fred. Now remember friends, we are still talking about consolidation. We are talking about group accounts. Now I am still developing this consolidation. We are still developing consolidation. And apart from that, we are talking about preparation. We are talking about the preparation of a group balance sheet. A group balance sheet. And don't forget, we are talking about the holding company and subsidiary. We are talking about accounting for is in respect to IFRS 10 and IAS 27, not forgetting IFRS number 3. Now, we have come a long way. We have discussed so many issues from our previous sessions. I think this is our 6th or 7th lesson. We have discussed so many issues. We have discussed, we must have started where the acquisition is at 100% and the date of acquisition is the same date of consolidation. We moved further, then we talked about acquisition is at 100%, but the date of acquisition is not the same as the date of consolidation. There we talked about the now coming in of the pre-acquisition and the post-acquisition. Then we looked at another example where the date of acquisition is not the same as the date of consolidation, but the acquisition is less than 100%. That's now where we saw the incoming, the non-controlling interest shareholders. Then later, we looked at an example where the purchase consideration had not been accounted for in the books. Apart from that, the purchase consideration is not only settled by payment of cash, but also issue of shares by the holding company. We looked at that. Then later, we developed this further. We looked at the element of other adjustments, other balance sheet adjustment, like the acquisition of preference share capital, acquisition of debentures and redeemable preference shares in the subsidiary. We have also looked at another example where there is a bonus. A bonus has been issued by the subsidiary, but that one has not been accounted for in the books. We have looked at that, friends. Now, in this scenario, we are going to look at the other balance sheet adjustment. And this time round, we want to look at intercompany owings. We also want to look at unrealized profits on closing stock. This session, friends, we want to talk about the two items. One, we want to talk about the intercompany owings. When you talk of intercompany owings, you not forget to talk about the items in transit. Then we talk about the unrealized profits on closing stock. So I remind you that we are talking about other balance sheet, other balance sheet, other balance sheet, other balance sheet adjustment. Other balance sheet adjustment when we are dealing with a subsidiary. We have talked about one, we have talked about the preference shares in the subsidiary. We have talked about that in our session. And number two, we have talked about in the debentures. When you talk of the debentures, don't forget to talk about the redeemable preference shares. Don't forget to talk about the loan stock as well in the subsidiary company. Number three, we have talked about the bonus. The bonus shares issued in the subsidiary. We have talked about that. So these are some of the items we have discussed already. Number four, we want to talk about the intercompany owing. Intercompany owing or intercompany debts. Then we also want to talk about the unrealized profits. Unrealized profits on closing stock. Now, before unrealized profits on closing stock, we should not forget to talk about the items in transit. Items in transit. Items in transit is part and parcel of the intercompany owing. Then we talk of the unrealized profits, unrealized profits on closing stock, unrealized profits on closing stock, on closing stock. So far, that's the other balance sheet adjustment. We want to talk about this. We want to talk about this today, and we want to talk about those 3 items. Then we do an illustration, maybe an illustration 7 and 8, so that we are able to be at par on that point. Then we look at 7, 8, and 9, and 10. You know, there is adjustment. There are more and more adjustment coming. Now, we want to talk about intercompany owing. That's the adjustment. We have looked at about this and this in our previous sessions. We want to look at intercompany owing. Intercompany owing. Intercompany owing or debts. Now, one group member, you know, we are talking about the holding company subsidiary, they are group members. One group member may owe some amount, may owe another group member some amounts at the balance sheet date. This same amount will be reported as a current asset in one hand and reported as a current liability on the other hand. For consolidation purposes, since they are group members, we should eliminate the intercompany owing, the like items. If this amount, if for example the holding company owes the subsidiary some amount, that same amount will be reported as a liability, as a trade payable or as a current liability in the balance sheet of the holding company, and the same amount will be reported as a receivable in the balance sheet of the subsidiary. Following the like items that need to be cancelled, then we need to consolidate. For the purpose of consolidation, we need to eliminate this intercompany owing. So you need to remember that. So intercompany owing, one group member owes another group member some amount. At the balance sheet this amount should be eliminated. We should be eliminated. We say should be eliminated as follows. We should debit the group creditors, then we credit group trade debtors or receivables by the same amount. Now friends, to make our life easy, in other words, it means that the same common item we reduce our creditors, the same amount we also reduce our trade debtors. To make our life easy, we reduce our creditors, we also reduce our debtors. We make our life easy. Then, now, at some point, the amount owed by each other to the other company may not be equal to each other, may not be the same. If they are not the same, then the difference is a cash in transit, or the difference is a goods in transit. So let me talk about number 5, items in transit. Items in transit may either be a cash in transit, a cash in transit. This is where intercompany owing are not equal to each other. Then the difference will be cash in transit. If they are not equal to each other, then the difference is a cash in transit. What to do with the cash in transit, friends? The cash in transit, thus, we are going to debit the cash in transit. You debit our cash in transit account, cash in transit, or or you debit the cash in hand, then you credit our group trade receivables. That's what you do. So with the cash in transit, debit your cash in hand or cash in transit, you credit your group trade receivables. Now, with that difference between the intercompany owing and the common item, that common item in the intercompany owing is what we are going to eliminate by reducing the creditors and reducing the debtors. B, we may have goods in transit. Goods may be in transit, goods sent from one group member to another group member, may be in transit at the balance sheet, date. Thus, we debit the group inventory, then we credit group trade receivables. That's what you do in case of a goods in transit. In case of a goods in transit. Fine. Now, after we have known that, then we need to move on to the next item. Number 6, adjustment. Number 6 is the unrealized profits. Unrealized profits on closing stock. We call it in brackets unrealized profits on closing stock. UPS. So unrealized profits on closing stock. UPS on closing stock. It must be on closing stock because we may have on opening stock. Opening stock is normally not reported in the balance sheet. So we are simply talking about the closing stock because that's what we report in the balance sheet. This comes in a scenario whereby there is intercompany trading, where a group member sold goods to another group member. Those goods may not have been sold to the outsiders or to the customers at the balance sheet date, now giving rise to unrealized profits. So we are saying the holding company or the subsidiary may sell goods to the other company during the post-acquisition period. These goods must have been sold at a profit. But unfortunately or fortunately, these goods may not have been sold to the outsiders at the balance sheet date, giving rise to a profit which had been reported as if it has been realized, but the fact is it has not been realized because the said goods have not been sold to outsiders. That giving rise to unrealized profits. Now this is unrealized profits is due to unsold. Unsold, let me say, is due to profit of unsold goods bought from one group member to another. Simple like that. Now, these unrealized profits may arise due to goods sold from one group member to another, goods sold from the holding company to the subsidiary, or goods sold from the subsidiary to the holding company. In other words, the unrealized profits may be as a result of downstream transaction or upstream transaction. Now, let's look at this. Before I say A, I say unrealized profits should be determined and eliminated. They should be determined and eliminated from the stocks because our closing stock should be purely at cost. We should move that profit that is included in either the holding company or the branch. So should be determined and eliminated. Determined and eliminated. So we are talking about unrealized profits that need to be determined and eliminated as follows. Let me say as follows. There are two scenarios. We may have downstream transaction as follows. A downstream transaction. In a downstream transaction, the holding company must have sold goods to the subsidiary. This is where holding company sold goods to the subsidiary. If the holding company sold goods to the subsidiary, then any profit they purported to have made, they only benefited alone. They never shared it. If the holding company reported a profit by selling goods to the subsidiary, then that profit they must have reported it in full in their books. So what we do to eliminate that, we are going to determine and debit our group retained earnings then we credit our group inventory. Remember, with the total unrealized profits. So we are going to debit the group retained earnings. We credit our group inventory with the total unrealized profits. That's in case of a downstream transaction. Now, in case of an upstream transaction, in this case, the subsidiary or the sub-subsidiary sold goods to the holding company. And these goods had not been sold at the balance sheet date. Because it's the subsidiary who sold, then any profit the subsidiary purported to have made did not only benefit the group but also benefited the outsiders known as non-controlling interests. So in this case, we say we are going to debit our group retained earnings with the group share of unrealized profits. We also debit the non-controlling interests. The non-controlling interest account with NCI share of the unrealized profits. Then we credit our group inventory with the total. Now, friends, look at that. Because it's the subsidiary who sold and who reported the profit, then that profit did not only benefit the group, but also benefited the outsiders known as non-controlling interests. Now, in this case, it means that we reverse the group share of the profit that benefited them by debiting the group retained earnings account and also debit and controlling interest with the NCI share of that profit that they purported or they must have reported in their books, which was had not been realized. Then we credit our group inventory. Friends, get this very clear that whether it's a downstream transaction or an upstream transaction, you must reduce your inventory with the total unrealized profits. In other words, you must credit your group inventory with the total unrealized profits. Whether it's a downstream transaction or an upstream transaction, you must reduce your inventory with the total unrealized profits. That's very important. Don't forget that. So we are going to deal with that. So you must reduce your inventory with the total unrealized profits. We are going to look at an example and see how that will work. So in summary, for this session today, we have looked at intercompany owings, we have looked at the items in transit, we have looked at the unrealized profits on closing stock. Then we'll continue looking at more other adjustment later. But before we do more adjustment, before we look at other adjustment to the group balance sheet, let's now look at an example where we are able to feature the intercompany owings, we are able to feature the items in transit, we are able to feature the unrealized profits. So we want to look at an example. Maybe this time round, this is our example number 7. We have it as example number 7. Example number 7. The following are the statement of financial positions of the two companies as of 31st December 2015. We have manifested limited and we have the vested limited. We have non-current assets, property, plant and equipment. We have the investment invested limited. We have the current assets. We have inventory, accounts receivable, cash at bank. We have the equity and liabilities. We have the capital and reserves, that is owner share capital. We have the share premium. We have the retained profits. We have the current liabilities. There's accounts payable. So additional information, friends. 1, Manvested Limited acquired 60% owner shares of the Vested Limited when the retained earnings of Vested Limited was 150,000 shillings. 2, included in the accounts receivable of Manvested Limited was 200,000 shillings due from Vested Limited. 3, during post-acquisition period, Manvested Limited sold goods valued at 300,000 shillings to Vested Limited. Manvested Limited sells goods at a margin of 25%. These goods are not being sold by Vested Limited and they were included in stocks of Vested Limited. Required: prepare the consolidated statement of financial position as of 31st December 2015. In other words, it means that our financial year begins January and ends December every year. That's okay, no problem. Like the current one begins on 1st January 2015 and ends on that 1st December 2015. So we have been told from the additional information that 1, Manvested Limited acquired 60% owner shares of Vested Limited, meaning 40% belongs to the NCI. They acquired at the date when the retained earnings was 150,000. Maybe many years ago. We acquired it maybe many years ago when the retained earnings was 150,000. Now, friends, the 150,000 is our pre-acquisition retained earnings. Then number 2, that included in the accounts receivable of Manvested Limited was 200,000 due from Vested Limited. Now, that is an intercompany owing. Remember, Vested Limited has not declined. They have not declined that we don't have the 200,000 to Manvested Limited. So it means that 200,000 is reported as an accounts receivable and the same amount, 200,000, is recognized as a trade payable in the books of Vested Limited. That's an intercompany owing. We are going to reduce our payables. We also reduce our receivables. Number 3, during post-acquisition period, Manvested Limited sold goods valued at 300,000 to Vested Limited. Manvested sells goods at a margin of 25%. These goods are not being sold by Vested Limited and they were included in the stocks of Vested Limited at the balance sheet date. So this means that there is some goods intercompany trading and some goods are not being sold. This gives rise to unrealized profit. They had sold goods and they had reported a profit, but this profit has not been realized because the goods have not been sold. That's important and we need to determine this. Remember, friends, that Manvested sold goods to Vested. That means it's a downstream transaction. That is the first adjustment is a downstream transaction. If you notice from this addition formation or from this question, we don't have the items in transit. We don't have the items in transit, and we're going to see the next illustration with the, talk about the items in transit. That's important. What we have here is intercompany owing, and we have the unrealized profits on closing stock as a result of a downstream transaction. Now we do the necessary adjustments as usual. So I'll continue from here. So we are talking about example. Friends, from the time we started introducing group accounts, this is our example number 7. So we are talking about example number 7, and one of the workings is the structure. Structure, we have Manvested Limited as acquired Vested Limited. 60% ordinary shares invested Limited. The pre-acquisition retained earnings of Vested Limited, we have been given as shillings 150,000. That's it. That's according to note number 1. Then we come to our working number 2. Working number 2, we are looking at I don't think that is a big deal, but our working number 2 is in respect to intercompany owings. So working number 2 is in respect to intercompany owing. We are going to debit our group trade payables by 200,000. Then we credit our group trade receivables by 200,000. Friends, in other words, we are going to reduce our trade payables by 200. We also reduce our trade receivables by 200. Working number 3. Our working number 3 is in respect to unrealized profits. Unrealized profits on closing stock. Unrealized profits on closing stock, it's a downstream transaction. It's a downstream transaction. That's okay. Apart from that, the selling price of these goods is selling price of unsold goods. We have been told that the whole of these goods had not been sold because they were included in the stocks of the Vested Limited. So it is shillings 300,000. We have been told that they sell goods, Vested Limited sells goods at a margin. So the margin, we have been given the margin at 25%. Now, you need to remember this business of a margin. You need to remember this business of a margin very clearly. You need to remember this business of a margin. When you talk of a margin, it's simply the gross profit over sales by 100. This is the same gross profit over cost of sales plus gross profit. This means to get the gross profit, or unrealized profits for that matter, we take our margin, you multiply the sales, or rather the selling price. So in this case, if specifically, we are getting the unrealized profit. We take the gross profit margin, we multiply the selling price of unsold goods. And in this case, we have the 25%, which we can easily say 25% of the selling price, 300,000, has not been sold. So what do we get there? So I take the calculator and realize that if I take 25% by 300,000, I'll be able to get 75,000. Then we are going to debit. Being a downstream transaction, we debit a group retained earnings, account with the 75,000. Then we credit our group inventory, account with the 75,000. Now, friends, don't forget that because we are discussing, or rather developing this topic slowly, for this case, it was a downstream transaction. We are going to look at in a case where it's an upstream transaction. We are going to reduce our retained earnings by 75,000. We also reduce our inventory by 75,000. That's very important. For in case of our upstream transaction, it will be a different case. It will be a different story. We have nothing else to make an adjustment other than those other workings. So we are talking about working number 4. Working number 4, we determine goodwill. We determine goodwill. Goodwill is, we can open the cost of control. We have the cost of investment. Our figures are in thousands. The cost of investment from our illustration, friends, is something to do with 1950. We have the ownership capital. We have acquired 60%. The ownership capital is 2,000 or 2 million. Then we have the share premium, 60% of the 800. Then we have the pre-acquisition retained earnings, 60%. Pre-acquisition retained earnings, 60% of 150. Then we have goodwill. So I'll take my calculator here and say 0.6 by 2,000, I'm getting 1,200. 0.6 by 800, I'm getting the 480. 0.6 by 150, I'm getting the 90. Then I say 1950 minus the 1,200 minus the 480 minus the 90, I'm getting 180 as our goodwill. We have 180 as our goodwill. I could easily say 1950 minus 60% of all those items, I could still get the 180. Then we go further and determine the group retained earnings.